That's like the value creation piece, right? It's not about misdirecting the users or tricking them to come to your chain or whatever. It's about providing them, giving them opportunities, giving them better experiences than they would have had elsewhere.
Hey everyone, this episode is brought to you by Namada, the shielded asset hub rewarding you to protect the multi-chain. So not only can you protect your own data across any asset and any chain, but you also get shielding rewards for strengthening data privacy protections for everyone. So you can check them out at namada.net and follow their mainnet launch. Stick around, you're going to be hearing all about them later in the program.
All right, everyone, welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer, the views expressed by my co-host today are their personal views and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
What's up, everyone? Welcome back to another episode of Bell Curve. Today is a really special episode, actually. I'm going to be talking to repeat guest and friend of the pod, Eugene of Ellipsis Labs, and Frankie. Frankie is lost on Twitter, is at Paradigm. This is his first podcast that he's doing. And we're going to be talking about Atlas today, which is a very exciting announcement that Eugene has been cooking up a little bit in stealth mode in his role at Ellipsis Labs. So those of you guys who haven't listened to previous episodes of Bell Curve and don't know Eugene, they're the developer of Phoenix, which is a DEX over on Solana, and they're launching their own SVM L2 that settles down to ETH today. So we got into it. We talked a lot about the architecture. We talked a lot about overlying trends, just about this whole ETH roadmap and being parasitic and why, with Eugene's background in Solana, why would he want to settle down to Ethereum? And we got into it as a really interesting conversation. I had a ton of fun. I will disclose as well that I am a small, proud equity holder in Ellipsis Labs. So just including that as a disclosure at the top of the episode here. But this one was a ton of fun, guys. I hope you all enjoyed it as much as I did. All right, everyone. Welcome back to another episode of Bell Curve. Today, we are joined by friend of the pod, Eugene of Ellipsis Labs. And we're also talking today with Frankie of Paradigm. And I believe, Frankie, this is your first ever appearance on a podcast. So very excited to have the two of you on here.
That's right. Thanks for having us.
Yeah, this is awesome, guys. And this is a special day, special pod, because we are actually going to talk about the launch of Atlas today, which is a new product that Eugene has been cooking up in stealth mode over at Ellipsis. So congratulations, Eugene, on getting that finally launched. I'm sure it feels very good. Why don't we just get right into it? What I want to do is spend this time talking to the two of you just about some of the high level stuff of why build and what is Atlas? First of all, it's a special type of layer 2, and I want to get into the weeds on the architecture and some of the reasons that you made the decisions that you did there. Why don't we actually just start with that, Eugene? Enough of me talking, man. Tell us about Atlas.
Yeah, absolutely. And thanks again for having me on. So today we just announced what we've been working on for the last year or so, Atlas, which is the blockchain for verifiable finance. And our idea here is to combine the performance of traditional finance with the transparency of DeFi. So for us as a company at Ellipsis Labs, we've basically spent the last 2 years building these financial primitives where the goal is for these on-chain financial primitives to compete on efficiency and performance with what exists in traditional finance. And as application developers ourselves, previously building Phoenix, which probably by the time this airs will have hit $50 billion in all-time cumulative spot volume. We've learned a lot about what the needs are on the infra side, really getting in the weeds on the application development side, talking to market makers, understanding all of their pain points. And so Atlas is kind of our response as the next gen infra layer for verifiable finance for these financial applications that are totally on chain, totally transparent and verifiable, and hopefully also competitive with Coinbase and Binance and the New York Stock Exchange.
Very cool, very exciting. And yeah, I should have actually started here by just, I'm assuming because you've been on the show so often at this point that folks would be familiar with Ellipsis. But yeah, you guys have done just a phenomenal job shipping Phoenix, which is one of the largest, most successful DEXs over in the Solana sphere. And I guess just to get into this, before we get into some of the technical architecture that makes Atlas very interesting, walk us through what was behind the decision to launch an SVM L2?
It's really a decision that comes from first principles. So first of all, understanding our advantages as a team, where we've been application developers on Solana. We understand the SVM extremely well. We've dealt with all of the ins and outs. And then when it comes to like building the right infra for verifiable finance, first of all, you need it to be verifiable. So it needs to be on chain and in some fashion. And then there are a couple of key components, namely execution and settlement, that are big decisions to make. And it's always possible to roll your own. But again, in our case, we're very familiar with the SVM. We're very confident that it is performant enough. And the developer toolkit and the set of developers is more than strong enough. It's very battle tested in production. So if the question is SVM versus EVM, it really comes down to performance, where the SVM is doing thousands of transactions per second in production adversarial environment today. We're not really seeing anything close to that with the EVM yet. I'm sure the EVM scaling efforts will eventually get there. But the SVM is scaling as well. The other thing we get from the SVM is because there is this notion of native state access lists, it's very easy to implement a local fee market. So you can actually have different state hotspots that require different amounts of fees that need to get paid. This also lets you get parallel execution pretty much out of the box. And then Ethereum as a settlement layer is kind of a no-brainer at this point, where, I mean, Ethereum just really focused on becoming the best settlement layer for quite some time. And so it really shows in the focus on availability and censorship resistance over things like really optimizing the hell out of the execution layer, which is what Solana's been more focused on.
Yeah, I'd say just to double click on the point about the developer community, I think over time we've seen a somewhat divergent evolution in the application design space between Solana and Ethereum. I think the SVM has sort of acted as a forcing function in that you can't just copy paste some EVM code and redeploy on Solana. So if you're going to have to build from scratch, you might as well build something new that really takes advantage of the substrate that you're building on. And I think this is an opportunity to now bring some of those lessons from Solana application design to Ethereum users so that they can use the applications with Ethereum assets.
Yeah, Frankie, that's such a good point, man. I honestly, the way that I would describe this as well is steel sharpens steel, right? So as we've unbundled a lot of the different functions that blockchains have historically done, Solana has focused quite a bit on execution, whereas Eugene, to your point, Ethereum has been pretty laser focused on being the best settlement layer. And it's been pretty cool, I think, to watch actually the success of Solana and that focus on execution actually push innovation on the rollup layer on Ethereum, right? So you see that from folks like the monads of the world, but also a lot of the L2s are starting to experiment with that as well, which is just, I think, just a super cool, very positive development for the entire space. And so maybe just to summarize here, so, some of what we're saying, I think there's the decision to be, an SVM based L2 on Ethereum. I've got some questions for Eugene about why, like what that really means with Ethereum being a great settlement layer and why that was more attractive maybe than building like an L2 that settles down to Solana. I think just for some of the other folks who are maybe a little bit less technical or forgot some of the differences in between the SVM and the EVM, I actually want you to walk us through like what are some of the trade-offs there. Those state access lists and enabling sort of local fee markets and parallelization, I think are really interesting. I just want to learn a little bit more about that. But what I really want to drive towards here is the design of Atlas. We talked about this a little bit even before we recorded this. You were very, very, I would say, opinionated in terms of the decisions that you made for constructing this L2, and are really building this as like an ideal home for DeFi applications, which I think is very cool. It's almost somewhere in between, at least in my mind, and you correct me if I'm wrong, in between this kind of very gen purpose L2 that we've seen from the Optimisms and the Arbitrums of the world, which is just come one, come all, right? I just want everyone to build here, versus a full stack Cosmos app chain, which is just kind of the osmosis, Binance on chain type thing. Whereas I feel like this is somewhere in the middle, which is a somewhat general purpose L2, but really optimized for DeFi applications, and the way that you've chosen to differentiate is by making some very specific decisions, which I want to get into. But before we get there, can we just start? You just give us a refresher, like for those of us who don't spend all day, in either the EVM or the SVM. Like, what are high level the sort of differences in between those two virtual environments?
Yeah, and I'm sure Frankie will have a little bit more to say on the EVM here. So the Solana virtual machine, actually, my co-founder Jerry's about to give a talk at Solana Breakpoint on what actually is the SVM. We can get really nitty into the details of what the VM is or isn't. I'm much more interested in what the VM enables out of the box. You can sort of do whatever you want in any VM. They're both pretty much Turing complete. And so it comes down to one, like how much performance, like raw performance, can you get in a single threaded manner? And then two, how much parallelism can you squeeze out? And now there's a bunch of other things too, like how is state represented? How do you Merkleize the state or compress the state into a way that where you can publish a useful state commitment to the layer one? And so those are some of like the custom things that we've had to build for Atlas, where they're not really important for Solana as layer one, but they're super important for Atlas as a layer two. But going back to what is really enabled by the SVM or like the existing SVM toolkit, so something like the state access list, this is actually proposed as like an EIP, an optional thing to include with transactions that are sent on Ethereum. I'm not sure if that EIP ever went through, but it's not like a VM level thing. It's more of like an implementation detail, how the execution environment, which is not just the VM, it's the VM plus a bunch of other things, how that's implemented. But all of the like existing Solana tools take this into account, which means pretty much every application developer on Solana knows how to use it. And that means we get the benefits of having the state access lists, which again are much easier to implement parallel execution and much easier to implement local fee markets, state-based fee markets, which again goes back to being able to parallelize the load.
Frank, I don't know if you have some more to say on this, especially from more of the EVM side of things as well.
Yeah, I mean, I think, there's scaling efforts throughout the whole ecosystem. So I think like today, EVM, especially on the base layer, execution is behind, but I think there's a lot of efforts to introduce like EVM performance. Reth is one such effort. You can get some level of parallelization, although it's quite harder without the access lists. And then you can make all sorts of perf improvements like just in time or ahead of time compilation. You can parallelize your state root computation, etc. These are techniques that are applicable sort of across the board. So I think, we'll see performance improve everywhere. But I think the SVM really gives you a strong baseline to make a lot of those performance improvements. And it was designed with a lot of this in mind. So it requires sometimes less work than it does trying to scale EVM.
And just the state access list as well, for folks who might not be as sort of in the weeds or familiar, that's just where what are the differences in between the SVM and the EVM is when devs need to specify upfront which part of the state this transaction is going to touch, right? So that later in the process, when transactions are being ordered, there's some understanding of which transactions can be parallelized versus not, right? So that's what we're talking about. And I guess the through line for me as well is that we're still in the throes and in the thicket of scaling these systems, and there was an enormous amount of work on the Ethereum side of things with 4844 and just blob pricing. But I feel like what we've sort of figured out since then is that there's still a bottleneck, and it actually still exists on the at the execution layer. So the SVM is a pretty big leg up in terms of the throughput that you can move through an L2. Do you guys get? Is that roughly correct? Would you say? I don't know if you.
I think it's a fair assessment given the systems that are currently in production. I think probably the EVM layer two, some of them could crank it up a little bit more, but I don't know if they could crank it up by like a factor of 10 or 100.
Yeah. Let's talk about some of those other, sort of more opinionated decisions that you've made around, like I thought enshrining an oracle was actually extremely interesting, Eugene, and maybe even before maybe even before we get into some of the specific decisions that you made with the architecture of Atlas, you just walk us through how you think about the philosophy of being opinionated versus unopinionated in your designs. Like I think that so far, if, you hear a lot of Ethereum protocol designers talk. I think there's been an overarching philosophy of pushing complexity to the edges and being this very neutral, unopinionated layer. And I think that some of the layers on top of Ethereum, both L2s and application, borrowed some of that philosophy, but it might not actually apply, right? Like that isn't something that should be carbon copied, I think, necessarily up one layer. The whole point of being neutral and unopinionated at the base layer is so that applications and different environments that are building on top of Ethereum can complement that with an opinion, right, so to speak. So just talk to us a little bit about how you guys, both of you, think about like this opinionated versus unopinionated design philosophy.
Yeah, Mike, I think that's exactly right. And Ethereum as this very credibly neutral piece of infrastructure actually makes it super useful for us because as a settlement layer, Ethereum's neutrality as well as its censorship resistance makes it really an ideal place to settle another piece of infrastructure to. For us, we're not infra developers at heart. We're really application developers. If we had it our way, we would be spending all of our resources, building out more applications and talking to those types of users rather than building out the infra. But Alice is really just the infra that we wish existed, that we wish we could build on top of, and we will build on top of it as well. And it just turns out like from the application developer's point of view, or from our point of view as application developers, there's a lot more of blockchain, especially a layer 2 blockchain, can offer that a layer 1 might not be able to. So, for example, with enshrining an oracle, really all we're doing there is enforcing this rule in sequencing, which is essentially that, hey, any transaction that comes from the oracle gets in maybe even for free, but certainly gets in as quickly as it wants to get in, such that even in times of high volatility, even if fees are spiking or it's like somewhat congested on the layer 2, we just guarantee that via the sequencer that the oracle is going to land. And it turns out, is this the most neutral thing to do? No, it's like clearly prioritizing these oracle transactions. There might be other types of transactions we want to prioritize or deprioritize as well. And at the end of the day, that has to serve the applications, which have to serve the users. So everything is coming from the perspective of how do we build the best infra for a specific type of application. For us, it's these verifiable financial applications. I'm sure it might make sense for there to be like a very gaming focused layer 2 with its own sequencing rules. Sequencing that is not just based on priority. It turns out for a lot of financial applications, it helps to have, well, first of all, obviously very high throughput and very low fees, but also, things like sequencing that looks much closer to first come, first serve rather than priority ordering. And I think the sequencer design is this area that's kind of been underexplored at the layer 2 level. We see a lot of reliance on priority ordering today, and especially in a regime where the sequencer is centralized. For, I believe, every layer 2 in production today, there should be a lot more room for creativity there. And so that's always just going to be this back and forth with application developers. You also want to be mindful of, as an application developer, if the infra underneath you is constantly changing, it's very difficult to build an application on top. And that also means you can't be changing up the sequencing rules all the time. But this also happens in other ways, right? Like, I think there were a lot of the early applications on Ethereum layer 1 were built without much of an understanding of how MEV was going to play out. I don't think anyone really understood how the MEV game was going to play out. And then certainly with like layer 2s today, we have a lot of applications that were built for the layer 1 that have been kind of mindlessly ported over to the layer 2. And maybe some of that doesn't make too much sense either.
Yeah, I mean, so I've got a lot more specific questions about that, but here's what I'll just say I really like about this, and it's a very refreshing new take. I feel like in crypto, one of the superpowers of our industry and just building things on chain is you can incentivize people with tokens, right? It's very easy to spin up markets. It's essentially very easy to incentivize people to bootstrap demand. And that's very cool. That's a really powerful lever when used very strategically. But I think also some protocols have run the risk of using that as a crutch, where it's just like, hey, I want gaming or this other application sector to come on here, so I'm just going to spin up this massive reward system for it instead of very intentionally designing the environment to attract those specific types of applications. And I feel like you've almost gone on the opposite spectrum and said, hey, I see this very broad swath of very attractive applications, which is DeFi. I know that here's what I think some common problem sets are for payments or on-chain order books or whatever it is. That's what they all have, and I'm going to design features that make it so that you'd be crazy to build anywhere other than Atlas. Is that like basically a fair assessment of your strategy?
Yeah, that's exactly right. And on the ecosystem development point, you touched on this a little bit earlier, but we really view ourselves, or we really view Atlas not as a general purpose blockchain, even though, yeah, the compute environment will be general purpose, and certainly not as a single application chain, but more as of an ecosystem chain. And honestly, we probably went into this on some old podcasts as well, but really the reason you want a bunch of different applications on the same chain is if they need to share a state or if they need to compose with each other. And I think there's a very easy story to tell that different financial applications might want to talk to each other, or users may want to use collateral from one application and go take it to another financial application. But I think there's not quite as strong a story for things outside of crypto finance composing with other things in crypto finance. So I think it's a very natural boundary to draw.
Yeah, you know what? I would be curious, and Frankie, I'd love to get your take on this as well. But this is something I've started to notice a little bit, and I don't want to derail us too much here, but something I've started to notice just looking at some of these L2s as a business model. It feels like, and I guess Eugene, this is a question for you down the line as well. Like if you ever have plans to develop this kind of stack, right? Like the OP stack, or Elastic Chains or Orbit Chains on Arbitrum or whatever. But it feels like the way that a lot of L2s have chosen to monetize is by charging for interoperability, right? They said, hey, we think that applications are going to want to own their own chain. And we think also that the killer feature to essentially include them in this bundle of OP stack being in the super chain is interoperability. And we're going to charge them for that. But then you look at some of these chains and, to your point, Eugene, they're not DeFi where there actually maybe is a real premium on interoperability, right? Or access to shared state. And there's kind of like some gaming chains, like the, world chain, like decentralized AI. And it's like, well, do you really need interoperability between these chains? Like, what actually is the benefit? This doesn't actually feel like a bundle that was constructed very, intuitively or very purposefully. So what do you guys think about that in general? Like for the business model for L2s, like, am I wrong here that it feels like the implicit assumption is that L2s are going to be able to charge for interop? Do you see a flaw in a business model? And Frankie, I would just like to get your whole take on, Eugene's strategy here of, specifying more for DeFi applications.
Yeah, I mean, I think it's a nuanced point. I think there's different kinds of interop that have different value. I think like at the base level, like the simplest form of interop is like I want to transfer my assets from one place to another, and I think like that's always valuable no matter what chain you're building, because like access to liquidity is quite important. Then yeah, if you're trying to build some sort of atomic interop, then I think it matters that the applications sort of play well together. So atomic interop between a gaming chain and a DeFi chain sort of doesn't make sense, or it would be hard to imagine that has a lot of premium. So I think it's important to keep in mind what the type of interop is. And then yeah, on the question of opinionated, unopinionated design, I think you had a good point that it's sort of, there's a spectrum where on one side you have current EVM layer twos, which are mostly unopinionated. They run pretty vanilla EVM execution. They don't try to make a lot of changes because they want to attract as big application base as possible, and then they try to differentiate on other factors. So either trying to push performance, leaning on branding, or like something more idiosyncratic, like access to a centralized exchange as an off ramp, on ramp, for example. And then on the other side of the spectrum, you have, as you mentioned before, Cosmos app chains. And this is the idea is like you can really program your full stack. So you can bring your own VM, you can modify execution however you want, and then you can also program a lot of stuff underneath execution. So the P2P layer, the mempool, block validity. And yeah, this gives you a lot of power, but it is also very difficult to onboard developers because the barrier to entry is much higher. I think something like Atlas is in a happy middle ground where you get mostly sort of vanilla SVM execution, so developers are familiar with how it works. It's easy to deploy applications on it, but you're also making these decisions at the margin of like how do you design your sequencer, what types of applications do you prioritize, etc. That really enable better DeFi applications specifically. So yeah, I think you get both a best of both worlds in that it's easy to come build an Atlas, but also you're building on a substrate that has been specifically designed for your application to be successful.
Yeah, I think it's just a very cool as a design philosophy. Actually, we did a not to give a self call here, but we did we did a whole season on app chains. Like it was the third season of Bell Curve, something like that. I did it with Miles O'Neill, and we actually ended up aligning. One of the questions that we were asking is like, what is the trade-off spectrum between like a an OP super one of a chain and the super chain on Optimism versus like a full stack app chain? And we actually said that maybe there should be something like more instead of app specific or general block space, like something like sector specific block space, which is it seems like what you've landed on here a little bit, Eugene. And I wanna get an understanding for you of the different types of DeFi apps that you're now I actually kind of want to get into some of the specific design choices that you made and what are the specific apps that you're trying to attract and what were some of the properties that you were gunning for. And I'll share my screen here and I'm just pulling up this is one of the tweets in your tweet thread today. But and we'll link this all in the show notes for folks that want to go a little bit deeper. I'm not sure if you can see here or if I'm zooming in, but basically, it said what you were the design choices that you lean into were speed of light, pre-confirmations, and an enshrined oracle. And some of the use cases that you walked through were on-chain order books, margin systems, and high-frequency trading. So, can you sort of compared and contrasted what a general purpose blockchain might offer versus Atlas? So, Eugene, can you just kind of walk us through, how do you align on speed of light pre-confs and an enshrined oracle as design decisions? And you know, help us translate into some of the different applications that you're trying to attract and the benefits for them.
Yeah, I would say both of these really came from us thinking through how Phoenix could be better, and in particular, how the infra layer could better serve applications like Phoenix. Phoenix, I would consider like a relatively beefy application, one where some entities here for us as market makers, it could be other types of entities for other applications, really, really require the high throughput and low fees, and they're placing and canceling tons and tons of orders. When we say speed of light pre-confirmations, what we really mean here is, we don't wait for, Atlas doesn't wait for 250 milliseconds to then go build a discrete block. Atlas is pretty much processing transactions continuously or as continuously as it can. You can think of it as much closer to first come, first serve rather than priority ordering, so continuous first come, first serve rather than discrete priority ordering. And so when a transaction comes in, if the system's not bottlenecked, the sequencer is going to process and execute your transaction and then send back the confirmation and state diff to the transaction sender right away, rather than waiting for an entire block to be produced. And actually, like the notion of a block even doesn't make too much sense on a layer two, because the actual unit of consensus is something like how often does the sequencer post a new state root back to the layer one, or how often are transactions posted to the DA layer, or how often does the DA layer come to finality. And then the oracle really comes from, again, seeing some of the pain points that are, Phoenix doesn't use any oracles, but some of our fellow developers on Solana have run into, especially during times of heavy congestion on Solana. And it turns out that the time your application needs the oracle the most is when there's high volatility, and when there's high volatility, there's more likely to be congestion on the chain too. So it's sort of like when you need it the most, it's least likely to be there. And so by enshrining it, you effectively are like carving out some small set of the block space, like reserving some of the block space for just the oracle. And maybe it's not going to use all of it. Maybe it's actually very predictable how much it's going to use. But you just always make sure there's this like fast lane available for the oracle to land whenever it wants to. And that means the application developer can build their application with the understanding like, okay, you're always going to have an oracle price from within the last, call it 1 second, but realistically speaking, like double digit, or call it double digit milliseconds. And that means you have a lot more freedom in designing your application versus one where, hey, usually the oracle is there every second, it's there every slot, but sometimes, and actually your time of need, it might not update for 10 minutes. You need to be robust to that case as well. So we're really defining the sort of characteristics of the chain that application developers should be able to expect. And in particular, like not throwing up our hands and saying, well, that's someone else's problem. At the end of the day, the infra exists to serve the applications. Infra doesn't exist just for the sake of existing. In the same way that Phoenix has a very core set of users, which is the market makers, and those like 4 or 5 market makers, we have to give really good white glove customer service to.
It seems like, Eugene, obviously these properties were designed to be very valuable for DeFi specific applications. And a lot of them, especially around the enshrined oracle, it seems like that was optimized to deal with congestion. And the way that this noisy neighbor problem has been there, but there have been a couple of different solutions to this noisy neighbor problem, I suppose, which you can now add this to sort of the bucket, which is one is just having separate chains, right? It's like, hey, don't worry, this isn't going to be all on one layer. We're just going to put it on a separate chain. The other is local fee markets, which are still, I don't know what the current status is. I know they were a little bit of a meme in Solana for a while. You would know better than me how effective they really are in production today. And now, like, one of the new buckets that I feel like you add is even deeper tooling and these separate swim lanes for Oracle updates and presumably other alterations that you'll make in the future. I have a question for you. I mean, is there a plan, right? And don't reveal any state secrets, right? I'm just curious. Like, what do you think about these like stack chain models where there's maybe like a main chain like Atlas One or whatever, and then a bunch of different chains around it? Or is the goal to keep all the different applications, like the DeFi applications that you're trying to attract, all on one layer?
For the time being, we are looking to keep everything on the same layer. I think it's really hard to tell what the ecosystem is going to look like at this point. And so it's tough to commit to, something a year from now or a few years from now. I think to Frankie's point, the types of composition that are valuable, even that is not super clear. And that is also going to be this emergent thing that comes from this emergent property of what applications end up being super useful. Maybe it is just going to be trading with on-chain order books and super efficient cross-margining systems. Maybe the permissionless innovation layer will deliver these totally new types of financial primitives that either require or don't require composition, that maybe require a totally different set of opinionated sequencing rules. So we pick the ones that we think are really important, and that's really informed by our experiences. But it's not 100% clear that these are the correct ones either.
Yeah, I'd also say there's sort of a key trade-off here where if you shard state, it allows you to scale, but it just fundamentally limits the interop that you can get. There's a bunch of solutions for interoping L2s, but basically it's very hard to beat applications co-located on the same L2. So you don't want to do the state sharding too prematurely. You want to see how far you can scale the L2 that you're working on, see what applications emerge, and then give yourself the optionality down the line if you need to. But yeah, I agree with Eugene that you don't want to do that too early.
Hey everyone, this episode is brought to you by Namada, the shielded asset hub protecting the future of the multi-chain. Namada is a chain that's near and dear to my heart because in previous seasons of Bell Curve, we've talked about how the cardinal original sin of most blockchains is not thinking about privacy from the beginning, but also because if we want to onboard a whole bunch of applications, it doesn't work in a default transparency setting. So Namada not only brings about a better future that we all want, but it's going to help onboard a ton of new applications. So Namada introduces a novel shielding reward system. The way that it works is if you hold your assets in the shielded set, you help strengthen Namada's data protection guarantees and collect non-rewards in return. Namada will initially support IBC and Ethereum-based assets, but eventually the idea is for this to expand into a comprehensive hub for all assets. Really, really excited about what the folks over at Namada are doing. I highly recommend that you go and check them out at namada.net. You can follow their mainnet launch, which is soon TM. Very exciting. Tell them that I sent you. Click the link, bottom of the show notes. Sounds like, Frankie, that might potentially be a commentary on another L1 that might have decided to shard so their execution a little bit early. Maybe I don't want to spend too much time on this, but I do want to get your take because this is the launch of this L2 is kind of smack in the middle of this. This is kind of the big debate that's going on in crypto right now, which is the Ethereum rollup centric roadmap. And, did we either move a little bit too, even if this was eventually the destiny of Ethereum and there are going to be a bunch of L2s, do we move a little bit too fast? Did we stop scaling the L1 before we ultimately ended up needing to? Are L2s like parasitic? Is this word that keeps getting thrown around quite a bit? And, Frankie, I would love to, maybe from your seat as at Paradigm, or as someone who's helped design Atlas a little bit, like what are your thoughts on this entire debate in general?
Yeah, I think, Twitter debate often lacks nuance. So
Twitter? Really? That lacks nuance?
Yeah, so I think that's part of the issue here. I would say, on the point of whether L2s are parasitic, you have to think about what drives the valuation of L1s. I think broadly you can break that up into fees and then monetary premium. Fees on the L1 come from a variety of sources. So base fee reflects just general congestion. Priority fees come mostly from MEV. And then you also have blob fees from L2s posting data to the L1. And then I think the question is like, as activity moves from the L1 to the L2, what happens to these drivers, which are fees and monetary premium? I think it's pretty clear that you'll see fees going down. So base fees will go down because just general usage and congestion goes down. Priority fees will go down because MEV moves to the L2s. Blob fees will go up, but right now they're so small that the net change is basically fees go down.
Right.
And then you have to look at what happens to monetary premium. So if Ethereum is widely adopted as the native asset of L2s, then it's more likely to function as money, right? You see it being used as a unit of account and as a medium of exchange in most of these L2s. So they're sort of counteracting forces. It's hard to tell exactly where we end up. So I think like calling it parasitic is sort of an unfair characterization at this moment.
So basically, and I just actually did a podcast on this last week, but the trade-off would be, okay, it seems like all of those fees, if you were to run like a DCF on Ethereum, the fees that when it was all one layer, Ethereum was printing back in 2021 and 2022, it's going to take a long time, if ever, that we get back to those level of fees. At some point in the future, I'm sure we probably will, but the amount of fees that are being generated by Ethereum right now are likely down only, and will continue to stay a little bit muted. And so if you're valuing Ethereum based on that, I can see how it would look a little bit not super positive. But on the other hand, there's this monetary premium aspect to Ethereum, which is, do people want to hold this as a money and a store of value? And when you have a really diverse L2 ecosystem where you can do things like build applications that you could never built on the L1, Atlas being an excellent example of that on the DeFi side of things, you're actually just growing the pie. And the hope is that people are going to want to use, ETH as a money on those chains. And so the liquidity network effects that you get with these, a multitude of L2s and apps, hopefully orders of magnitude larger apps and users on those L2 using ETH as money, that's going to outweigh the fees that you lose. Is that like roughly the size of it?
That's right. Yeah, I think that's a fair summary.
Okay, cool.
I think like at the end of the day, if you're really focused on fee capture, like the way you grow the fee capture is first by growing the total size of the pie, growing the total value created. And if you look at like Ethereum, or you look at, let's say, all blockchains today, there's what, maybe 100,000, a couple 100,000 like actual users.
Yeah.
Even that's even like very small compared to like all like crypto users, right? Most crypto users are just centralized exchange users. I believe Coinbase is like 10 million monthly users. Binance probably has more. And so I think the focus really ought to be first on like creating applications and experiences that users actually prefer to their centralized counterparts. That's like the value creation piece, right? It's not about misdirecting the user, sort of tricking them to come to your chain or whatever. It's about providing them, giving them opportunities, giving them better experiences than they would have had elsewhere. And then the value capture, I think, comes far later, and it's like very unclear at this point. Does the value go to the infra? Does it go to the applications? Maybe it goes to like the stack or aggregation layer. Who knows? I think it's like way too soon to tell. And again, a lot of this is very path dependent. Maybe it'll go to some very vertically integrated team. But I think the discussion around like, are the L2s parasitic is a little bit premature and is mostly driven by this angst around the token price. Like I think if ETH was at 4K or 5K right now, it's like no one would care whatsoever, even if the fees were still down.
Yeah, I am fully in the camp that price drives narrative and not the other way around. And the cure for this is definitely a healthy bit of number go up. Well, Eugene, I actually would love to get your take in general, because you used this phrase right at the beginning that Ethereum has optimized for being this settlement layer. And could you walk us through in a little bit more detail, why you decided to, I mean, you guys built Phoenix on Solana, you decided to use the SVM. I feel like a lot of your DNA is sort of in the Solana community. And I'd just be curious why you made the decision to have this settle down to Ethereum. And even if we could get in your definition, like try to pick apart some of the technical decisions that Ethereum has made to optimize as a settlement layer versus the $300 billion of crypto native capital that exists in the form of ETH asset versus the 80 billion on Solana, and how both of those factored into your decision.
Yeah, so settlement gives you a bunch of different things. First of all, there's like some requirements you have from a settlement layer, or like let's call it a set of different things that you settle to. So there's this data availability component, which Ethereum has been building towards for quite some time. Previously used to be rollup transactions getting posted to call data. Now they get posted to the blob storage. And then there's also this notion of how do you build the native bridge to the layer 2. And there's a couple of properties you want from your layer 1 if you're building a layer 2. One of them is censorship resistance, because the way layer 2 inherits like availability from the layer 1 is even if the layer 2 sequencer is censoring a user or some set of users, they're still able to exit via the escape hash. They're still able to permissionlessly include transactions. And so it's actually very important for a layer 2 that the layer 1 is as censorship resistant as possible. And then you also touched on the point about assets, where you get access to the set of assets on the layer 1 in this trust minimized way. And yeah, there's hundreds of billions of dollars of assets on ETH mainnet. And a lot of those users who hold those assets just like haven't just like haven't gotten exposure to, this set of Solana applications. I often hear from Ethereum users or layer 2 users moving over to Solana feels like, stepping a few years forward in time. That's the type of experience we would like every Ethereum user to have, whether it's on Atlas or somewhere else. And so settling layer 2 to Ethereum, I think, is just kind of a slam dunk for us.
So I want to poke at that a little bit, and so here's something that I've been thinking. So you mentioned the forced inclusion and kind of like the escape hatch, and I want to ask you guys a question that I've had in the back of my head for like a couple of years and never really feel like I've gotten an answer to. And I'm sure maybe you guys have thought about this before. And then, the other thing is just what are the properties that an L1 affords their L2s? And I think like settlement assurances is definitely one thing, but the other thing I've wondered that Solana has that might make something like base sequencing a little bit easier is it's just got much faster block times, right? So there are all these, you got to jump through a bunch of hoops on the Ethereum side of things because you have 12-second block times to, if you wanted to have Ethereum sequence transactions, having rollups wait 12 seconds would obviate basically all the benefits. So you have to do this kind of fancy pre-conf system, which feels a little bit tough. But on something like Solana, maybe interop would actually work much easier because you could just easily ping transactions down and then back up. I actually think Rome is basically there's a protocol out there that is trying to get people to use Solana as just a shared sequencer anyway. But I want to start with this first question I had for you guys, which is, Eugene, you guys are trying to attract businesses to build on Atlas, right? You're trying to attract applications. And the benefit for users, right, is that if there were ever some, sort of catastrophic fault or the sequencer got compromised or whatever, the users could port their assets down. But, let's say I decided to build my application on Atlas. I'm not saying this would ever happen, but this is relevant for every L2, right? I decided to build my application on Atlas. Something ends up happening and all the users, start to move their assets off the chain. I can't really port my business off the chain, right? Like I've built on your specific SVM, customization. Most of the other rollups that exist on Ethereum today are EVMs, and like I couldn't really just take the business that I built here with all my customers and activity and just move that over to say Arbitrum or Base or something like that. So I get it from the user side, but do you see is there a challenge there from the business side of things where there's no such thing as an escape hatch for apps that get built on rollups? And do you see that as an issue?
I might not be understanding the question all the way. I think kind of no matter what, if you're an application, the infra has some catastrophic fault. First of all, the most important thing is users are able to exit,
Right.
Exit in like a safe and obviously like relatively cheap manner, even if maybe it takes longer than you would like. And then second, like once your users and applications, or sorry, your users and assets, or even like the underlying infra is gone, like you kind of don't really have anything anyway.
Yeah.
So I'm not sure if I really understand the question here.
Okay. I guess then the idea just being, okay, so your users and your user assets are protected, but there's still maybe some degree of platform risk for L2s that you're taking on as an app, choosing.
I think as an app picking any infrastructure, you are taking on platform risk in the same way that if, we built a SaaS app and we put on AWS, there's some AWS risk. And in fact, like you do realize that risk every now and then, or building on any layer 2, you're depending on, that layer 2's bridge to remain secure, or any other, like, I mean, it's true for any application and any infra, or really anything you decide to depend on. Maybe that's a little bit too reductive of a view, but as as application developers, I can tell you that I'm sure every application developer takes this decision very, very seriously. Like when you are betting on a particular piece of infra, especially something as fundamental as a blockchain, you're effectively betting your whole business on it, and that's not an easy bet to make.
Yeah, I think a core point here is like, a lot of the times, if you're an application developer, the moat, a lot of your moat is basically the valuable state that you've built up on a certain chain. And the reason it's a moat is because there's no way to transfer that state, right? Like whether it's liquidity or user base, etc. So yeah, wherever you build, you're taking on that platform risk because that state is just locked into the substrate that you're building on.
Gotcha. And then maybe Frankie, that second question to you of just like, how would you think about, okay, so Ethereum has sort of optimized for being a settlement layer, and that means, prioritizing things like censorship resistance, through their network of home stakers, et cetera, et cetera. Are there any benefits to building an L2 on Solana? Like the one that I, as sort of a lay person, just having, like shower thoughts about this basically, is just that the slower block times might make interop between L2s a little bit easier, at least as like a first run kind of janky solution. But are there any benefits that you guys see to building on Solana, or do you think that for the most part into perpetuity, L2s are going to be built on ETH?
Yeah, I think Eugene covered this pretty well. If you're building an L2, there's a few things that you care about, and I think Ethereum so far has really optimized those. Solana so far has optimized for execution, and that works really well. But yeah, if you're building an L2, you care about having a trust minimized bridge to Ethereum is quite valuable because it gives you access to a lot of liquidity and a user base. That is quite valuable. You also care about, yeah, there's some nuance about like what does it mean for an L2 to inherit security from the L1, especially when you get these constructions that use off-chain DA. But one property that you really care about is, yeah, the censorship resistance of the L1, because you need to use the force inclusion mechanism, and Ethereum gives you pretty good assurances in this case. So yeah, I think definitely Ethereum has been optimized for the L2 use case.
Guys, talk to me about how you're thinking about MEV from an Atlas perspective. So I think a lot of the mental framework that people have around MEV is from the Ethereum based perspective, where there's a public mempool and transactions sort of float around for 12 seconds or something like that, and searchers or integrated searcher builders will package up a block and then distribute that to whoever has the block monopoly, like whichever proposer is in line to propose the block. In Solana, it looks pretty different. There's no public mempool. Transactions just get auto forwarded onto the leader, and there's sort of continuous block building. And it sounds like, in the L2 space in general, it's more along the lines of what the Solana MEV environment looks like, in the sense that there's no public mempool, and a lot of the challenge from the centralized sequencer, L2 perspective is just mitigating spam essentially. And we kind of saw this with Arbitrum, which had a very opinionated design around MEV to begin with, where they were just FIFO, and now they've added a sort of time boost kind of priority ordering mechanism there. Eugene, how are you thinking about this from the Atlas perspective?
Yeah, I mean, I think your description of the current state of the world is pretty accurate. On layer twos today, we mostly see things that look like priority ordering and yeah, no public mempool. And so you end up with like basically this top of block LBR auction. I don't know, this usually somewhere between like 250 milliseconds and probably like 2 seconds for the block time. And then you have this other stuff that happens at like the bottom of the block where because you can't really observe the the state at the time you send the transaction, you send these like optimistic transactions, which I believe were first seen on Polygon. They're very, very prevalent on Solana as well, where basically what you do is you sort of try to reserve the block space and then do the searching totally on chain and then revert if you didn't find a profitable trade. So I think like priority, like all these priority mechanisms are kind of like bait for mechanism designers and paper writers, and in practice, like do not lead to very good applications. At the very least, we haven't seen that so far. Um, for applications that rely on active liquidity, like order books, for example, um, really you want to roll out the red carpet for the market makers because market makers provide liquidity and they in fact compete to provide the best liquidity, which is like the tightest liquidity or the deepest liquidity. And if the takers have an advantage over them, then, or even if they're on like a level playing field, the makers are forced to provide wider, and you sort of have this like leakage from the system, which we can call MEV, which is like just going to the takers, or in the case of a system like Solana, going to some combination of the takers and the validators, and the application would like to internalize that as much as possible. So for us, I think like the first come first serve model or some like close variant of this makes a little bit more sense, where instead of having your maker orders just sitting around and effectively looking like a free option for anyone else to go pick them off, the maker is able to like cancel as quickly as they want, and maybe the takers don't get the privilege to take as fast as the makers. That's just like one idea. Definitely not something we're committed to. But there's this notion of, again, like designing the applications, which is both like our own applications as well as other teams that are building on top of Atlas, along with the infra itself, to create the best overall experience for the users. And we'll figure out things like the value capture later. The most important thing is like the value creation and creating these differentiated experiences and applications for the users.
Yeah, Frankie, I don't know if you have anything to add there other than, I'd love to get a sense of how you guys think about, I have a feeling I know where you guys maybe lean on this question, but there is a question philosophically of who deserves the MEV, or where do you think it's going to end up, sort of from a pragmatic standpoint? And this has always been a little bit of a challenge from my standpoint on why I know, on the multi-coin guys look at MEV as kind of a primary way of value accruing, especially to L1s. And now recently there's been kind of a discussion of, hey, is it going to end up with L2s maybe, or even apps? And then I think there is a pretty broad school of thought, which says actually, we should try to minimize MEV where possible, but also to return it to users, right? The users are the ultimate originators of MEV in the first place. And it feels a little bit funny to be counting this as revenue when really where that revenue is coming from is users getting screwed in a sense. And so I would even just love to get a sense from the two of you philosophically, just, where do you see, who do you think really deserve, like where should the MEV be going? And then based on what's out there in the market today, where do you think it's going to wind up getting routed to?
Yeah, I mean, I think if you look at at things from first principles, and the thing that you're optimizing for is how do we create the most value and how do we create the best experience for the user, then it's clear that you need a mechanism to rebate the MEV that users create back to them. And yeah, I think there's like multiple different approaches to this today. There's a lot of like application level MEV capture. So the basic idea is like just design your applications in a way that don't leak MEV, so that you don't have to rely on infrastructure level rebates, which can sometimes be inefficient. Basically, it's sort of a patch over bad application design. There's a lot of, on the other hand, infrastructure level mechanisms to try to rebate this MEV. Obviously, like we don't live in a world where every application is thoughtful about this design, so it's still important that you have a way to capture it at the infrastructure level. But yeah, I think overall, you want to create good experiences for users. You can't have them leaking massive amounts of value to this sort of supply chain, and that requires both thoughtful application and infrastructure design. And as Eugene was saying, if you're able to sort of co-design both the application and the infrastructure, then you can achieve really strong levels of redistribution.
I don't have much to add there. Eugene, I saw you nodding, or looking up thoughtfully and metaphorically stroking your chin. So I'm assuming you agree with that.
I definitely agree with what Frankie said. I think always like the question of, who deserves MEV is kind of a loaded question. I think maybe more interesting or easier to answer is like, where is it going to go? Which again, I think is still this very path dependent thing, but ultimately I think it just ends up accruing to the layer of the stack where like you have a defensible position. And so I think a lot of times like at the infra layer, it's like just not super clear how long-term differentiated it is. in many other businesses, we talk about like commoditizing your complements and whatnot, and sort of you want like the layer above you to be a commodity, the layer below you to be a commodity, and so like all the value sort of goes to you. Um, I'm not sure if it's going to play out exactly like that in crypto, but we sort of see this, in, again in sort of like other businesses. We see like bundling and unbundling. In crypto, we're seeing like aggregation and disaggregation. Um, and I feel like these cycles are just, going to continue. And then the way you actually end up with this very defensible position is if you have like far, far, far superior products, or if you have really, really strong network effects. Um, but I think like these network effects also look like impenetrable moats all the way up until the point where they get busted. So um, yeah, I think it's like very, very difficult to predict, like most things about the future.
I agree. It's it's definitely tough, and I wonder. We saw an early version of a trend that might, what might be the beginning of a trend, start to play out with. I think shared sequencers maybe, found out that there was a little bit of a challenge between getting originators of user flow, or like order flow, basically, to opt into their network. I mean, I could see the same argument actually being made for generalized order flow auctions as well. It's like, okay, why am I opting into this network if I could just internalize this and return it to my users, especially if it's not a 1+1=5 situation and there's not a lot of like dex to dex, arbitrage that I can do. Why would I be opting into this? So I think that's yeah, I think we'll see if it ends up happening at the application layer or the infra layer. The other thing that I would just add to this as well is regulation will be a factor here. The like kind of the early decision, and I understand why it happened with MEV boost, was a lot of that MEV was siphoned off and returned to proposers, but you know I don't think regulators would look at that system and particularly love it, or think that it's the best devised system in the world. So I think eventually the regulators will probably start peeking under the hood and maybe have their own perspective on where it should go, and that will influence things. All right, last set of questions for you here, and then I know we got to start to wind down. Just I'd love to end on this subject of opinionation here, and I think one of the really interesting things about Atlas and you and your team, Eugene, is that you guys started as application developers and then built the infra that you wanted to see in the world. And this has been a recurring challenge in crypto, where there's a chicken and egg problem. Hey, we don't have any apps, so we're going to build infrastructure for the apps, but then the infrastructure is supposed to support the applications, and so there's this chicken and egg problem. And I think you're one of these emerging entrepreneurs in crypto that actually started with an application, recognized that the infra didn't exist, and are kind of building both at the same time. So you're definitely chewing glass at the moment. So props to you. But in addition to what you've built so far, I understand that there's an intention to actually build more first party apps. So can you just walk us through that decision making process, and then what, if anything, can you share with us about other first party apps that you might be interested in developing?
Yeah, it's really quite simple. At the time Atlas mainnet launches, it has to ship with a full suite of financial applications. And so the ones where we think they're well served by others building on top of Atlas, then we don't need to build it. And then other ones, yeah, we'll probably just have to build. That suite, like the bare minimum suite, looks something like spot trading, a margin engine, and probably some sort of futures trading,
Yeah.
along with obviously a strong set of assets and market makers to make the applications run. We have a lot of interesting ideas on the spot trading side, also on the margin engine side, I guess. And yeah, we've been chatting with a bunch of teams, both like inside the Solana ecosystem and from elsewhere, basically on should we do it, or should we have another team build it? I think like one thing for sure for us is we will be building at least one application on
Yeah.
Atlas. I think it's super important to dog food your own product. I think there's a lot of infra out there where the infra builders just don't have any empathy for the application developer that's using the infra. It's sort of like if you're building, I don't know, like a social media platform or like a SaaS app, and then no one on your team actually use the product, you're going to have a very, very poor view of what the user experience actually looks like. And so I think it's like really important, just as a form of dog food in our own product, to build something and try to take something to production along with Atlas.
Mm. And how do you guys both think about, maybe Frankie, I'll kick this one to you first, the trade-off of building first-party apps versus third-party? And the trade-off is just a layperson looking at the situation is, even if you look at Ethereum versus Solana as a point of comparison, in Ethereum, because they had this very push complexity to the edges design philosophy, what it's encouraged is it's actually sort of helped build like bootstrap community and VC investment, because Ethereum does so little and is so non-prescriptive about what should be built on top of it. It's encouraged this large community of infra builders, essentially, right, which has been kind of nice in a lot of senses. Maybe the downside of that would be, though, that there are some critical parts of the infrastructure where maybe you don't actually want this to be third party, and that could be, in Ethereum's case, that could be liquid staking or something like that. And so I would just love to kind of compare and contrast and get both of your guys' senses about how you might think about pros and cons of the building first party versus third party apps sort of trade-off, and yeah, how you might walk through the decision about this should be first party, this should be third party.
Yeah, I would say one point worth keeping in mind is like this decision is quite different at the base layer than at the L2 layer, because you want different things from them. So it's important that the base layer be neutral, and it's like, yeah, it wouldn't make sense for the EF to start building applications directly. I think for when you're building a layer 2, you can be much more opinionated, as Eugene has said. So I think, basically we're still very early in I think the crypto story, and the main goal is to like grow the pie. So I don't think there's a lot of like tension between first party apps and third party apps. And like the commitment that Atlas is making is like, we'll build infrastructure that is specifically tailored for this set of applications. And the best way we can do that is by building applications ourselves. There's a certain level of empathy that you just cannot get unless you're sort of in the trenches with the rest of the developers, building and pushing the boundaries of the system that you're on. So I think, yeah, it's really valuable to have the team building applications, and you get a lot of benefits from this like co-design of the infrastructure and the application layer.
Yeah, the only thing I would add is you still want to make sure that there is room for this ecosystem of third-party applications to breathe and to flourish. I think we have plenty of good ideas here at Ellipsis Labs, and a lot of talent as well. But we're certainly not going to invent everything useful, or frankly anywhere close to everything useful that ends up on Atlas. And so want to make sure there's still plenty of space for others to innovate and utilize the infrastructure beyond ourselves as application developers.
Awesome. Well, maybe as a way of winding down here, what let's say that there are some application developers out there on the DeFi side of things that are listening to this and saying, hey, this is sounding pretty good. Enshrined Oracle, I'm not gonna have to worry about my Oracle updates not getting pushed, and this all sounds really interesting. How could they find out more information or look to maybe build on Atlas?
Yeah, for sure. So our testnet is available today. It's a private developers only testnet, and we're rolling access out relatively slowly just to make sure the system stays stable as we scale it up. But you can find us at atlas.xyz. There's an easy way to contact us, tell us a little bit about yourselves and sort of what you're looking to build on top of Atlas. We have some, I call it light documentation there as well. But yeah, certainly very, very keen to speak with any developers who are interested in building on top of Atlas, whether or not they end up committing. We always learn a ton talking to other application developers.
Awesome. And Frankie, for folks who want, now that you're podcast official, my man, if folks want to either follow you on Twitter or find out more about the work you do, what's the best way to do that?
Yeah, Frankie is lost on Twitter. And then, yeah, as Eugene said, we're very excited for folks to build on Atlas. So if you're interested, reach out to Eugene, reach out to me. We're happy to spend some time jamming on ideas.
Awesome. All right, guys, this was a ton of fun. Congrats again on the launch of Atlas. And yeah, guys, we'll have to do this again sometime soon.
Thanks for having us, Mike.
Thanks, Mike.
Cheers, guys. Hey, everyone. Hope you all enjoyed today's episode. Want to give a final shout out to Namada. Again, a team that is near and dear to my heart. They are building the Shielded Asset Hub, which is protecting the future multi-chain. Talked a little bit about how that works in the mid-roll, but for now, what I would highly recommend that you do is go check them out. They're in their mainnet launch phase. You can follow along with everything at namada.net. You can start rewarding yourself by shielding your actions and strengthening data privacy for all across the multi-chain. So thanks again, Namada, for all the great work that you're doing.